Welcome back, guys. In this section I'm going to be talking about one of the most important aspects of your trading career, which is risk management. Risk management has to be one of the top aspects that you're gonna have to learn and master in order for you to progress well in your forex trading career. So in this section we're going to look at some of the criteria and aspects that you need to put into consideration for you to come up with a proper risk management system. So what is risk management? Risk management is divided into two fundamental values. Number one, equity management, and number two, trade management. Risk management is the only shield that you have against ultimate failure in the forex industry. Many people, they fail in the forex industry not because they don't know what they'll be doing, or not because they don't have a good strategy, but most importantly because they don't have a proper risk management system that they follow. The reason for the small risk of 2 to 3%, remember I've always highlighted that you need to risk at least 2 to 3% of your equity, is because you absolutely must plan on having losses. It's inevitable. Losses are inevitable, even a string of losses. So the 2 to 3% should be the most you allow yourself to lose on any one day as well. The moment you see yourself losing above 5%, 10%, then clearly you've got something not right. Your risk management is not right, because that kind of a loss is not going to make you last in this game. For multiple positions, cumulative risk should not exceed the above numbers. What this means that, say you've got 3 or 4 positions opened, those 4 positions, they shouldn't exceed 3% of your equity. You do not have to trade much to make a lot. Remember, one position is enough. You don't need to be always in the trade, always opening positions. No, make sure when you open a position, it's a position which you have analyzed thoroughly and with the odds in your favor. You see, make sure you are entering a position whereby the direction is highly likely to be in your favor. If you want to last in this industry, I would highly recommend that you keep your overall risk to no more than 3% of your total account value. If you believe you are really strong technically, you may want to go to 5%, but that is the outright maximum per trade. 5 losing trades in a row is inevitable. You're gonna have losing days. You're gonna have a streak of losing days, but it's how you manage your risk that will make you stay longer in the game. Focus on trades that will pay you at least 3 times the amount you risk or more. 1 to 2 risk reward ratio is acceptable as well. Ideally, stops should be 10 to 20 pips above or below the nearest key supply or demand level respectively. So it could be a key supply zone or it could be a key demand zone. Yes, some people, they like to place their stops above key support zones and key resistance zones. Swing lows on a 15-minute chart with trailing stops 10 to 20 pips under it would be an example of a long positioning utilizing this method. We are always looking for opportunities to reduce and or eliminate risk in every trade that we execute. Remember, when you're in a trade, always remember to also take partial profits if the trade goes against you and you leave the rest running. If we are net long, we should look to move our stop up to break even as soon as possible and still be within proper trade management rules. We look at every trade in two portions. The first portion takes partial profits at 30 or more pips. The remaining portion is held to the ultimate profit objective. So what this means is, if you are in a trade, right? Say the trade is going in your direction and you're in a trade with a 0.8 lot, right? Let's say you're in a trade with a 0.8 lot size, and then the trade moves in your direction 30 pips, right? The trade move in your direction plus 30 pips. What you can do is you take off a portion of this 0.8 lot size, meaning you can scale down to say, you can take off say 0.4. That's 50% scaling. Then you leave the other 0.4 to run up until the ultimate profit objective. Remember, this is the first initial objective. This trade can even run as long as the momentum keeps going. Let's say you are long and your ultimate objective is here. You can even keep adjusting your take profit as long as the conditions are ideal for you to keep following price. So that's how you look into it in two portions. Like, you take off half of the position when you're in profit 30 pips or more, and then you leave the rest to run up until your ultimate profit objective. So now let's look at risk reward ratio. The risk reward ratio measures how much your possible reward is for every dollar that you risk. If you have a risk reward ratio of 1:3, this means you are risking $1 to potentially make $3. If you have a risk reward ratio of 1:5, it means you are risking $1 to potentially make $5. Now let's look at how that illustrates. So here I've got a table showing a win-loss over 10 trades with a risk reward ratio of 1:1. So if you win 10 trades and lose 0, it means you've got a 100% win rate, right? If you win 9 and you lose 1, 90% win rate. So this is self-explanatory up until if you lose 0, if you win 0 and you lose 10, that's a 0%. So this table is based on a risk reward, assuming your average profit of 20 pips and an average stop loss of 20 pips. So if you win 8, that means you have got yourself 160 pips, but you would have lost 2 trades, meaning 40 pips that you have lost. So in other words, a risk reward ratio of 1:1, you will need to win at least 6 trades out of 10 for you to stay in profit. Because 6 out of 10 trades, it means you can afford to lose 4 trades, but still you've got a net pip of 40 pips. So to break even, you are going to need to win 5 out of 5. That's break even, you see. Now let's look at another example. Every good trader knows that relying on hope is a losing proposition. Being more conservative with your risk is always better than being more aggressive with your reward. Risk reward is always calculated realistically yet conservatively. Now let's look at another illustration of 10 trades, but this time with a risk reward ratio of 3:1 or 1:3. Same criteria applies. We are risking risk reward assuming an average profit of 100 pips now and an average stop loss of 30 pips. So with 10 trades, 0 losses, that's 100% win ratio. You see now the difference here is that we are targeting a 1:3 risk reward ratio. So that means out of 10 trades, we need to win at least 3 trades and lose 7 trades for us to be profitable. So whatever strategy that you use, if you find yourself with a strategy that does not give you at least 3 out of 10 wins with a risk reward ratio of 3:1, if you don't get at least 3 out of 10 with a risk reward of 3:1, then that strategy is not working. You need to change your trading strategy, because with the risk reward ratio of 1:3, you can afford to lose 7 trades, but still at the end of the day or end of the month, let's say, you still be in a winning position. I hope you perfectly understood what I was trying to illustrate there. Let's continue with our risk management. Things to take note of: never move your stop loss away from your entry point, because that basically means you're now increasing your risk. Avoid auto trailing stop, rather elect for manual stops, right? It means if a trade is in profit, make sure it's you who's gonna trail that stop loss, not auto trailing. A swing point is a simple 5 candle formation. A swing high is any bar with 2 lower highs on both sides of it. A swing low is any bar with 2 higher lows on both sides of it. These swing points can offer reference points for stop loss placement and the stepping stone to identify key supply or demand areas, market overflow, and market structure. You see our swing high. Let's say you would have shorted, you would have went short here. This would be your entry point to the downside, right? If you enter here, it means your stop loss is 5 to 20 pips above this high. See what the market did? It created another swing at a demand level, right? So by the time it created this swing, you would have already taken some portion of your trade, right? And then the market swing to the upside. Same applies if you are taking a long position from this entry. It means your stop loss 10 to 20 pips below this swing low, and market rallied all the way to our previous supply zone. So this would have been a very nice trade. So that's how you should aim to trade, how you should aim to place your stop loss on areas of swing high or swing low, 10 to 20 pips below. So good risk reward management. What are the possibilities? Let me just give you an illustration of the possibilities of having a proper good risk reward reward management system. The illustration below shows what only a net gain of 50 pips per week can produce, and never risking more than 3% of total equity and risking 30 pips per trade. If you look on the illustrated chart, right, starting equity is only $2,000, right? And with a monthly goal of 20% of 2,000, which is $400, that will be your monthly target. And risking 3% of 2,000, which is $60, and with a 30 pip stop loss and the value of $2 per pip, targeting 50 pips per week. That means you're targeting 200 pips per week. With this risk reward management, it will only take you a year to grow your equity from 2,000 up until just under 15,000. That's a very good, reasonable growth for such a small amount of equity. But the moment you follow this risk reward management system, you can see that it's something which is quite achievable. 50 pips per week, that's easily achievable as long as you have a good strategy. So 200 pips per month should be your target. You should aim to at least get 200 pips per month from your trading activity. 50 pips, 10 pips per day, Monday to Friday. You are getting 10 pips. You see? If you want to trade 3 times a week, say you trade Tuesday, Wednesday, and Thursday, then you're looking at about 17 pips for each of those 3 days. If you're only trading 2 times a day, 2 times a week, then each and every day for those 2 days, you are targeting just 25 pips, which is highly possible, guys. Look at it from a higher perspective. 20 pips, 50 pips. That is quite achievable. It's not something which is difficult to attain as long as you know what you're doing in the market. So this graph representation shows you how 2,000 can actually grow within a period of, say, 2 years. You can actually grow your 2,000 all the way to just under $133,000 within a period of 2 years. That's if you have the discipline, the proper risk management, the proper discipline, and good strategy for your trades. This is quite easily achievable. You can make all the money you did ever need or desire, and do so with less than 30% of your total equity. The edge for new traders to be a millionaire or next guru is so powerful, guys. It can cause traders to deviate from their risk control and, even worse, their trading plan. More money breeds greed for even more money. Build your equity steadily and slowly. You will need time for your psyche to be accustomed to the normal equity dips associated with proper equity growth. If you rush it and overtrade and or over leverage the account, you'll be emotionally charged and you'll find yourself needing the trades to end profitably versus following the plan and taking what the current market environment is presenting at that time. When a trade goes wrong, you must always know when to fold on the trade and cut your bait. If you are wrong, you must admit that, okay, this is not correct, I was wrong. You take the losses and move to the next setup that provides itself. So this is what I just wanted to share with you guys in regards to risk management and what risk reward ratio to follow. So basically, you mustn't risk more than 3% of your equity, and always aim to get at least 1:3 risk reward ratio on your trades. So if your stop loss is 20 pips, make sure you're targeting something more than 60 pips. This will make you stay long in the game. You progress much better without any stresses or having to trade against the market or revenge trade or anything. If you are wrong, you must admit, no, I was wrong. Then you move on to the next trade. So I'll see you again in the next section. I wish you all good luck and happy trading. Thank you.